Your next monthly statement will likely look a lot better than the last one you got. Could we finally be emerging from this severe market downturn? We explore in this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, this is our first Fastest 4 in August, so let's start with a look back at July. In the midst of disappointing economic news, the stock market rallied. The S&P 500 was up 9% in July. That was the best performance in the month of July in over 80 years, and it was the best month period since November of 2020. And we talked last week about why the market may have responded favorably to that economic data that was released. So this week we'll focus on where do we go from here? And the big question that has grabbed headlines in the past couple of weeks is, are we in a recession? That was fueled primarily by second quarter GDP numbers, showing a second straight quarter of negative growth. Now that has been the traditional, albeit simplified, definition of a recession, but there are many other factors. In fact, the National Bureau of Economic Research has been given the authority to officially declare a recession, and they have not done that yet. However, from a market perspective, the better question here is what happens to stocks if or when we are in a recession? A chart from LPL Research shows us the 13 recession periods since World War II, and you can see that the average length of a recession is 10 months long. The longest, a year and a half, the shortest, 2 months. That, of course, was the COVID shutdown. The average length of an expansion following a recession typically lasts much longer, with an average of more than 5 years. This should give us perspective that if or when we enter a recession, it is typically just a blip on our longer path of economic growth. The other thing to point out here is that during a recession, your equity holdings may actually do quite well. Using another chart from LPL Research, it shows us that looking at the same 13 recessionary periods, in 7 of the 13, stocks actually went up, and in some cases, rather significantly. In fact, the average performance for the S&P 500 is positive, although barely, at 1.3% during a recession. This goes back to the concept that we talked about last week, and that is we discuss frequently on the Fastest 4. In fact, the stock market is a forward-looking mechanism. Much of the bad economic news tends to be priced in before we actually enter a recession. That makes it very possible that we hit the market bottom before we get out of the recession. One more chart for you. Again, looking at the previous 13 recessions as defined by the National Bureau of Economic Research, in 12 of the 13, the market bottomed before the recession ended. That indicates that the market rally could happen during the recession. It would also seem to indicate that we could still have a lot more volatility ahead. We may not challenge the market low of June again, but we should not believe that the market will go straight up for the rest of the year. Of course, we're not in a recession yet, but as an investor, we should let the experts make the call and not make the call ourselves by bailing out of stocks. We may miss out on a rally that begins before we expect it. Thanks for listening.